Dividend growth is one of the most popular investment strategies because it offers the possibility of earning dividends and really passive income. The goal of many people is to be able to save enough cash in dividends to meet all of their financial obligations and yet have money left over to live life to the fullest. However, investing in dividend growth has a huge drawback. Furthermore, you may already be familiar with what we're talking about if you've watched other YouTube videos. A sizable stock portfolio is required in order to be able to live fully or partially off of dividends. In other instances, YouTube dividend investors have held nearly $1 million worth of stocks and ETFs to get to this point. Obviously, a large portion of investors find this to be rather disheartening. Hi, welcome to Stock Market Mate, a channel where future billionaires and millionaires can learn how to make prudent investments. We'd like to discuss one of the most well-liked investment strategies with you in this video: dividend growth. Please subscribe if you're new to our channel to see more content much like this. Let's get going. Johnson & Johnson. Tell us now whether the scenario seems even remotely similar. Let's say you're 30 years old, and you make the decision to start investing in dividend growth. You take $10,000 out of your savings and put it in Johnson & Johnson, one of the most well-liked dividend growth stocks on the market. Johnson & Johnson have consistently grown their dividend payout over the previous 58 years. For dividend growth investors, this acquisition appears to be a no-brainer in addition to its rising stock price. Before you know it, you're on the road to a prosperous future that is filled with passive income. You then understood that, with the current market price of 166.48 cents per share and a dividend yield of just 2.48%, Johnson & Johnson stock only provide $1.01 for each share you own each quarter. For each Johnson & Johnson share you hold, this works up to slightly more than 33 cents a month. 60 shares of Johnson & Johnson might be purchased with $10,000 invested at $166.48 per share. With 60 shares, your quarterly income would be $60.60, or just over $20 per month. It doesn't seem amazing to make $20 a month by investing enough money to buy a high-quality used car, does it? But now, let's look at the main rationale for dividend growth investing. Every year, J&J increases its dividends. So long as the business doesn't experience financial difficulties, they'll continue doing it each year. You just need to be patient then. So you start receiving more and more money back over time. Let's imagine you decide to research Johnson & Johnson's dividend increases in depth online. You discover that, historically, they have barely increased their payouts by 4 to 6 cents annually. A dividend forecasting tool can assist in estimating your future earnings. The annual dividend growth rate of J&J stock is around 6.13%. as reported by Seeking Alpha, which will help us determine how much our payouts will rise. If you did not reinvest your income for the $10,000 examples after 40 years of waiting, you would have only made a measly $41,138.62 of your original investment. You would have earned $64,231.12 in dividends if you chose to reinvest those dividends. Or in other words, if you chose not to spend a single penny of your dividend income on anything you actually desired, such as a new automobile, a relaxing trip, or simply paying your bills for 40 years. Dividend growth stocks. If Johnson & Johnson seemed to be the exception in this case, you will discover a very similar pattern with other extremely well-liked dividend growth stocks. Let's compare J&J to some of the most well-known dividend-paying stocks now trading. On this page, you may see 3M, another stock with a strong dividend growth profile. This company now has a dividend yield of 2.98%. Procter & Gamble offer a 2.55% dividend yield. McDonald's owns 2.21% of it. The list goes on with another 2.2% for Emerson Electric. As previously indicated, you can surely keep buying more shares of Johnson & Johnson and other dividend growth stocks in coming years. It will get harder though, if you want to be able to live off profits for the remainder of your life without getting too old. After understanding this information, it's not unusual for investors to give up on dividend growth investment, realizing that they won't be able to live off dividends till they are quite elderly and gray-haired. Furthermore, if you're close to retirement age, you don't want to wait a long time for your J&J dividends to increase in value. You're looking for stocks that will generate high dividend returns today rather than tomorrow. Maybe you'll have more than $10,000 to put into investments. Being a dividend growth investor won't be perfect though, unless you're fortunate enough to have millions of dollars saved. You must fit one of two categories to be a dividend growth investor. Either you have a sizable amount of cash to invest, or you are young and prepared to make significant financial sacrifices now in order to build wealth for the day when you won't be able to enjoy the dividend income you receive. We totally understand if you want to live like Warren Buffett. As if it were a game of running off the score, all they are interested in is investing more and more. But keep in mind that Warren Buffett is renowned for being thrifty with his own money. Therefore, it is obvious that you need to diversify your portfolio if you want to start generating a consistent stream of dividend income immediately rather than waiting decades. Covered call ETFs. It comes as no surprise that you should concentrate on your assets with higher returns. However, there are a few things to bear in mind, like avoiding investments in businesses that carry a lot of risks or whose dividend payouts are steadily dropping. In our opinion, covered call ETFs are the best sort of investments for someone looking for substantial dividend income, as well as an increase in the share price and distribution amounts. These investments aren't as well recognized as other type of investments, but they can be a fantastic source of income. Covered call ETFs would be the first item we'd invest in if we had $100 or $1,000. The most popular covered call ETF, QYLD, now pays dividends monthly rather than quarterly and has a dividend yield of 11.49%. To fully understand how these exchange-traded funds are able to pay out such high dividends, some basic knowledge of options is required. These ETFs use the covered call investment technique, whereby the fund buys a selection of companies from the Nasdaq 100 and then sells call options on those stocks. These options are sold each month, and the option premiums collected are then paid out as dividends to investors. As a result, we as investors gain from growth as well as the incredibly generous monthly dividend distribution. According to Seeking Alpha, QYLD's dividend has increased consistently over the past 2 years. That already has an 11. In case you forgot, the dividend yield was 49%. Another great option is the Newsy ticker sign. For this reason, in addition to purchasing call options, it also sells put options. The share price of Newsy will not decline as much as anticipated on days when the Nasdaq declines, which is what this ETF duplicates. However, compared to the other ETFs, this one's dividend yield is much smaller. It is much higher than the national average, even at 7.88%. This fund was only established in December of last year, 2019. And since then, both its value and its share price have increased significantly. At the current share price of 22.56, we can purchase 443 shares of QYLD. At the current share price and yield of 11.49%, if we reinvested our first $10,000 in that business, you would receive $101.13 per month from 443 shares. Johnson & Johnson's monthly cost of $20.20 isn't any better, is it? If all your dividends were reinvested each month, picture what a sizable income-producing portfolio would look like. Dividends can be spent some months and reinvested in other months, so living solely off dividends is not necessary. BDCs, or Business Development Companies. BDCs, or Business Development Companies, are another great investment that pays out larger dividends to investors. Since 1980, they have essentially been firms that provide loans to small and medium-sized businesses in order to support their growth. These small businesses are required to give the BDC a tiny percentage of their profits in return for borrowing. The BDC must then, under legal requirements, distribute 90% of the funds they earn from these small firms back to shareholders in the form of dividends. For BDCs, dividend yields of more than 8% are not unusual. However, the majority only pays out once every 3 months. Which, if it's still making significant dividend payment, isn't that bad, right? We find 2 stocks in the BDC industry to be particularly noteworthy. The world's largest business development corporation, Ares, comes first. This yields a dividend yield of 8.18%, which is exceptionally high. New Technology is yet another. This company's dividend has increased significantly. BDCs and covered call ETFs are just a couple of the investment types that offer high dividend yields. Other choices to think about include investing in real estate, trusts, closed-end funds, master limited partnerships, split share funds, and others. In conclusion, you should concentrate on specific alternatives to lesser-known, higher-yielding investments if you want to live off your gains much earlier in life. To build a portfolio significantly more quickly, reinvest dividends as often as you can. You can also spend income in some months, say on a vacation, and reinvest in other months. You'll be surprised by how much motivated you are to be a dividend investor after using this strategy. We don't know about you, but seeing a $20 gift from Johnson & Johnson in our brokerage account wouldn't inspire us nearly as much as seeing QYLD's $102 monthly payment would. Dividend investments surely has an emotional component. And that's it for today. What do you think about investing in dividend growth? Participate in the discussion by leaving a comment below. If you like this video, please click the like and subscribe buttons and hit the notification bell. We'll see you next time. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!